Hello, fellow rebel capitalists. Hope you're well. So, it is time. We've got about 9 minutes before we get the big Fed rate decision. What are they going to do? Are they going to pause? Are they going to cut rates? And then what will the market reaction be? What will happen to the S&P 500? What will happen to the 10-year Treasury yield? Mortgage rates, all of these rates that are far more important than just Fed funds. What banks are lending to what interest rate banks are using to lend to one another overnight. So we got about 8 minutes now. Let's do a screen share and go over to what interest rates have done today. And then while we're I want to hang out and with all you guys and hear what Jerome Powell has to say as well. What we're expecting, what the market is expecting, is a hawkish cut. Right. So he's going to cut rates, but then come out and say how, just you wait and see. Don't you expect another rate cut? Absolutely not. Just like he did last time. Don't expect another rate cut. No. And that's what the market's expecting. We'll see what we get. But then I want to kind of build on that last video I did and talking about if the Fed rate cuts even matter. And what I'm referring to is the real interest rates that are used in the real economy, and mainly like the 10-year Treasury yield. So in past rate cutting cycles, what have interest rates done? Because if you listen to the mainstream media, if you listen to the talking heads at the Fed, they would like you to believe that if the Fed cuts rates by 100 basis points, and then every single maturity along the Treasury curve is just going to come down by 100 basis points. So if they cut by 100, then the 2-year should come down by 100. The 10-year should come down by 100. 30-year come down by 100. Or at the very least, they want you to believe that if they cut, then the 10-year Treasury might not come down by 100, but the 10-year Treasury will at least come down because the Fed's cutting rates. Right? So this is one of those things that I've noticed, and there's a lot of things like this that I've noticed since starting this YouTube channel and really getting neck deep in this stuff on a daily basis. And what I'm referring to specifically is there are all these things that are just said over and over and over and over again to the point where people don't even question them. Like they just assume that it has to be true, or else everyone wouldn't be saying it, so I don't even have to research it. And the Fed lowering interest rates is the exact same thing. And so I'm going to wait here to dive into it because I want to look at the 10-year Treasury and what it has done in the past during these Fed rate cutting cycles. Let me give you guys a quick preview of what I want to talk about after we get the news here in 5 minutes. And then while we're waiting for Jerome Powell to speak, I think you guys are going to find this fascinating. I did a super, super deep dive on this yesterday in Rebel Capitalist Pro for members. So it's kind of fresh in my memory. And I think I'm probably going to do a whiteboard video on it tomorrow. But let me show you right here. So this is the Fed funds rate. Josh, can you see that?
Yes.
Okay. And we don't really consider anything prior to late 80s. Why is that? Because I'm cherry picking data? No, because that's when the Federal Reserve started to target interest rates. Prior to Greenspan, they didn't target rates. So if you go back here, and Paul Volcker gets all this credit for breaking the back of inflation because he had the guts to raise rates. Paul Volcker didn't raise rates. I've actually gone back, which I'm sure very few people have done, and read the reports from the Fed. And what you see is that he had a 4 percentage points window on rates. So right here, when the Fed funds rate got up to 19%, Paul Volcker would have said, well, yeah, whether it's 17% or 21%, whatevs. Oh, it's just somewhere around there. It's just wherever it's going to go, it's going to go. So whether it's 17%, 18%, 20%, 21%, I don't really care. It's just the market's going to take it where the market's going to take it. But for some reason, history remembers him as the guy who intentionally increased interest rates. Now, what he did do is he tried to target M2 money supply growth. So the rate of change in M2 money supply growth. And he tried to do that by micromanaging bank reserves. He did do that. But unfortunately for Paul Volcker, it didn't do anything. If you look at the M2 money supply growth, it's even when you do like a log chart, it's like beep, straight line. Like he literally didn't do anything, or at least he tried to do something, but the net result was nothing. And but what he did do, which I completely give him credit for, whether it was intentional or not, is he basically got out of the way and let the market right here dictate interest rates. And the market did what it needed to do to break the back of inflation. Paul Volcker just happened to step aside and be at the right place at the right time. But anyway, getting back to Greenspan, he's the first guy that really started to target rates. So that's why I like to focus on the late 80s, early 90s recession. So we see this big Fed rate cutting cycle. Then we see another one here at .com. We see another one, GFC. We saw another one, obviously, during the survey sickness. And we see another one right here. Big Fed rate cutting cycle. And I don't really pay much attention to this one because why am I cherry picking data? No, because you didn't have big inversions of the curve. You didn't have a deteriorating labor market. You didn't really have this. So it wasn't really, it's kind of apples to oranges. So what we can do, which we'll do here in a couple minutes, is we'll look at these cycles and we'll figure out not what the narrative is, but what interest rates really did during these cycles. And then from that, we can come to some conclusions as to how much or how little the Fed controls interest rates across the curve and what we should expect to see. Again, no certainties, only probabilities. But what we should expect to see throughout the rest of this cycle and whether or not this cycle is completely unprecedented. And then most importantly, with those conclusions, taking those conclusions and turning that into something that's actionable for your portfolio. That's what I want to do on this live stream. So with that said, let's go over to CNBC and U.S. seizes oil tanker off the coast of Venezuela. Oh, that's good. Always nice to see that we're going to war with another country. But of course, it's about the drugs. I mean, if you think this is about drugs, wow. I've got some oceanfront property in Arizona to sell you. All right, let's keep refreshing here. Okay, Fed meeting live updates. Great. We've got 1 minute here. Look at this. Why the Fed rate cut could boost private equity deal making after, what are you talking about? If you guys don't know why I'm so frustrated, watch the last video. Almost the entire front of the curve is inverted. It's lower than Fed funds. Them dropping 25 basis points, it's not going to do anything. It's not going to do anything to the curve. It's not, I mean, look. Yeah. So stupid. I feel like I'm taking crazy pills. So if you didn't watch that last video, just really quick here while we're waiting for the report. I looked at the curve, which used to be here. I don't know why it all of a sudden disappeared. There it is. And you can see just going out to 3 months, the curve is inverted. And so why does that matter? Because if the Fed drops 25 basis points, guess what it's going to do to the 1 year? Guess what it's going to do even out to the 3 month? I mean, you could maybe argue that because short-term interest rates go a lot lower, then that may facilitate deal making. But short-term interest rates are already lower than Fed funds. So the only thing the Fed is doing is bringing Fed funds down to where short-term interest rates already are. Like, what are we talking about here? Or maybe a little bit, I guess the 3 month is at 3.72 and Fed funds right now, I don't know, maybe 3.85. But I mean, is it really going to facilitate deal making if the 3-month treasury goes down by 5 basis points? I mean, come on. This is nonsense. All right, let's get back to it here. Divided Fed approves. Third rate cut, sees slower pace. They always say that. That's exactly what they said during the last meeting. Remember, Powell came out and he says, well, don't price in future rate cuts. No. And then 3 months later, yeah, we're cutting rates. But whatever you do, don't price in rate cuts. I mean, how can we take these people seriously? How? How is it possible? Let's see, make sure I'm seeing this right here. So they cut 25. Okay, I don't know why they don't have anything explaining it, but based on this headline, they cut 25. And how do they know they see slower pace ahead? Do they do a statement? I thought they did that statement at 2:30 when Powell comes out and starts blabbing. Well, I'll take them at their word. So US mandate check, tourists, blah, 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 blah. Let me just keep refreshing here. I mean, I think the main takeaway here is they dropped 25, just like the market expected. Let's see, divided Fed approves. Jeez, this is annoying. Let me just go to Twitter. This is what's great about Twitter. You know, Twitter, for the most part, is just a dumpster fire of just obnoxious people trying to dunk on one another. But it is good for real-time data. So let me just see here. Fed meeting. Okay, yeah, so they cut 25 basis points. Okay, cool. So now let's go over and quickly see how interest rates are responding. And I'm going to be shocked if the 2-year treasury didn't come down by 25 basis points. Geez. And I know they're pricing it in, but they're pricing in a cut. And that's pretty much my point here. So we got, oh my gosh, whoa. Time out. The 10-year treasury is down by 2.6 basis points. Look out, inflation. Oh my gosh. Oh, we're going straight to the 1970s now. Oh my, no. It's down by 3.2 basis points. Whoa. The CPI is headed straight for 10%. And honestly, it's probably just a knee-jerk reaction. It probably gets down in here, then probably comes right back to where it was. Let's gee. Oh, but the opposite is true. Like, I don't want to seem like it's just ridiculous that this would somehow impact inflation, because it's also completely ridiculous that this would somehow impact the labor market. Like, okay, the 10-year treasury yields down by 3 basis points. Oh my gosh. Everyone's going to get a high-paying job now. Like, geez, what's the 2-year doing? Two years down by 5 basis points. Yeah, I mean, pretty much what you'd expect. I mean, on a personal note, we'll go over to the TLT. This is not investment advice. This might be a lag, though. Is TradingView lag? No, that's probably, so it's kind of jumping all around here. It's like, shrugging it off. So that's probably the 20-year, 30-year. Here's the 30-year, actually. Yeah, no, nothing. Let's look at the dollar. Okay. I mean, dollar down on the day, but didn't do anything. Okay. So now that we're waiting for Jerome Powell to come out and give us his incredible words of wisdom, and where the dot plot is going from here on out. Now we can actually have a serious adult conversation about interest rates for people who are actually thinking. And let's go to some charts and let's go to the history like I was talking about. Josh, we still good with the screen share? Yeah, okay, cool. So like I said, we're going to go over to Fed funds, and this is kind of just a super brief like overview, Reader's Digest version of the deep dive I did for the Rebel Capitalist Pro members. And with the Rebel Capitalist Pro members, I was kind of thinking it through in real time. So this hopefully will be a little bit more polished. Okay, so we've got this. Let's go ahead and zoom in. These Fred charts are great. You can just go 1988. There we go. And you can see we start here April, call it April, May of 1989. And then the Fed rate cutting cycle is done, call it December 1992. So we've got about May 89, December 92. And you can see they dropped by a lot. a lot. They're almost at 10%. And they get all the way down to 3. I mean, they dropped by almost 7%. So call it 650, 700 basis points. Okay, now let's see what happened to the long end of the curve. The 30-year is this green kind of dotted line. The 10-year is the blue line. And we're going to go back to the same time frame. We'll just say 1988. And then we'll go to, where did we cut the other one off? 93 or so? I can't remember. We'll just do 1993. Okay. So right here, we can see that, what was it, May 89? So right around here is when they start cutting. And you'll notice, I mean, you fast forward 2 years. I mean, we go to, call it April of 91, and interest rates are almost identical at the long end. So, and then we go to, what was it, December 92? So that would be here, right around there. And are interest rates lower then? Yeah, they are. They are. But are they down by 7%? Not even close. Not even close. And again, but look at this 2-year span from, call it 89 to 91. So that would have been here to here. I mean, you got interest rates dropping by 4%. 4%. And when I talk about interest rates dropping, I'm talking about Fed funds down by 4%, 400 basis points. And the long end of the curve is basically flat. So this is why I, especially in these videos and in the whiteboards, why I always like to go back and look at history and look at the charts and forget the narrative. Forget what social media is saying. Forget what the mainstream media is saying. Just forget all of these, all this dogma that exists in finance and in economics that's just based on something being repeated over and over and over and over and over and over and over again. And then it's exacerbated by everyone taking that thing that's repeated over and over and over again, assuming it to be true, and therefore putting a huge amount of emphasis on it, not even realizing that, and not even taking the time to do something like this and say, oh, well, wait a minute here. Maybe the Fed doesn't really matter as far as interest rates in the real economy. So so think about that. From right here to right here, we had the 10-year Treasury flat. The Fed dropped by 400 basis points. So you tell me, how would that have propped up the labor market? Because that's the Fed's dual mandate, right? It's the labor market and inflation. So if they're cutting rates by 400 basis points, what that means is they're trying to stimulate the economy. Great. How are you stimulating the economy if the 10-year Treasury is flat for 2 years? You're going to tell me that has a massive stimulative effect? And even if you want to argue that, well, you've got a lot of corporations that have short-term debt and they're rolling it over and blah, blah, blah. Okay, fine. That's the 2-year. So maybe the 2-year goes down. Maybe it doesn't, but to say that the be all end all in terms of inflation and the labor market is the Fed, it's a joke. It's a joke. Just like today, when the 2-year is down now by, Fed cuts 25 basis points and the 2-year is down by 5. Now, again, was this priced in? Sure. But even if the Fed would have paused, do you think that the 2-year would have gone up by 25 basis points? Absolutely not. It would have gone, the market would have been offsides. So the 2-year would have gone up to maybe, I don't know, 3.67, something like that, maybe 10 basis points. Or maybe it would have gone up to 3.7 or something like that. And so again, you have to ask yourself, how is that going to dramatically impact the labor market? The answer is it's not. It's not. Now, if the Fed cuts by 300 basis points in a meeting, okay, maybe we got something to talk about. But what they're doing is they're just following. They're just following the 2-year. They're basically just following wherever the market is. And therefore, what they do, it's not moving the needle because the Fed doesn't control the interest rates. And that's blatantly obvious when you just look at history. So now let's go back to that. And what I want to highlight now is like this time from, what is this? December of 89 to, call it August of 90. Look, interest rates went up. Now, keep in mind, this is when the Fed is cutting, or they're at least in a cutting cycle. They may have been paused here or something like that. But interest rates at the long end of the curve go up by, let's say we start at, let's say 7.75, and we go up to, call it 9. So interest rates went up by 125 basis points. The real interest rates that matter the most, I'm talking about the 10-year Treasury yield. So how did that help the labor market? How did that help the housing market? It didn't. In fact, it would have helped inflation. You see, this is the irony that all the time, but especially during these rate cutting cycles, a lot of times the real interest rates that matter are doing the opposite of what the Fed is doing. So you could even argue that the Fed cutting rates is actually a preventative tool for inflation. And sometimes them hiking rates is a boost to the labor market because the real interest rates that matter do the opposite of what Fed funds is doing. So now let's go here. So we know for sure, at least looking at this cycle, now maybe the GFC is different. Maybe the .com is different. So let's dive into that. But we know definitively during this cycle, the long end of the curve did not go down. In fact, it really can't go down because the curve always steepens out. So by definition, the long end doesn't go down as much as the front end. What we can determine during this cycle is that rates actually did finish lower. So that's good over the whole entire cycle. But does that because of the Fed, or is that because of growth and inflation expectations? That I would argue it's because of growth and inflation expectations. It had nothing to do with the Fed. The Fed was just following it. Okay. And then what we can also say definitively is that there are long periods of time during these rate cutting cycles when the interest rates, a lot of the interest rates in the curve, are doing the exact opposite of what the Fed is doing. So think about the narrative here, that if you had been watching CNBC and the Fed is cutting rates, it'd have been like, oh my gosh, they're going to they're cutting too fast. The inflation genie's coming out of the bottle. I'm sure there's dissension back here during this time, or maybe there was, maybe there wasn't. But if there's dissension among the ranks, the argument is, oh my gosh, if we cut too fast, We cut too fast, the interest rates are going to be way too low, and therefore inflation is going to rage higher. While they're having this debate, the 10-year treasury yield is giving them the finger and going up by 125 basis points. And they're sitting there quibbling over whether or not this next rate cut is going to lead to inflation or help the labor. I mean, it's freaking insanity. Okay, but maybe it's just this cycle. Maybe the .com and the GFC is different. So let's go over here. And okay, here we got a rate cut starting, was that right around November 2000. Okay, cool. And we finish around July 2003. All right. So that's almost 3-year period. We go down by, what is it, 5.5%? So 550 basis points. So now let's look at the long end of the curve and see what it did from basically end of 2000 to almost the end of 2003. We'll go 1998. Ooh, it always does that. So I got to start with this one. So we'll go 2004. We'll go 98. Okay. Now, we don't even need to look at Fed funds. You can see that this is the exact same. Shocker, right? That yes, at the end of the cycle, it is true. Interest rates were lower, but they didn't go down near as much as the Fed dropped, which makes sense. The curve's going to steepen out. But what doesn't make sense at all is that there are long periods of time here, notably, right here, where the Fed is cutting very, very quickly, and the long end is actually going up. They're cutting to support the labor market, while interest rates are actually going up. That would be a headwind to labor markets. Yet again, during this time, I'm sure they're sitting there arguing and debating as to whether or not the next Fed cut is going to lead to booming inflation. Or how much the next Fed cut is going to support the labor market when the 10-year treasury yield is going from, call it 4.8% straight up to 5.5. I mean, it's the same thing that happened this cycle. Remember when the Fed started cutting rates, they dropped by 100 basis points. And what happened along into the curve? It went up by 100 basis points. And meanwhile, the mainstream media is just completely ignoring that and just being like, oh my gosh, did the Fed cut too fast? Like, yeah, they cut way, way too fast. I mean, if anything, you could argue that the long end was going up because of growth and inflation expectations from the Fed cutting too fast. But we know what happened there, right? Interest rates went up. What happened after that? They come back down because reality sinks in about the economy slowing down and that being disinflationary, not inflationary. Okay. So we don't even have to look at Fed funds. You see, this is the exact same thing. And by the way, they're probably cutting in here, or at least paused. And you have another look at the 10-year. It's going from 4.3 up to 5.3. So here it's going up by, call it, what was that, 75 basis points or so. This is going up by 100 basis points while the Fed is dropping, or at the very least paused. So from this cycle, we can also definitively conclude that the rates did not go down even remotely close, even after the cycle was done, versus the Fed funds rate. And during long periods of time, while the Fed was dropping, the important interest rates in the economy were actually going up, doing the exact opposite. Then we go to the GFC. Actually, I got to do this one first. Go to 2000. Go to 2011. And we'll go 2005. And it's just more of the same. I mean, here they started cutting. I remember it was September. Right around September. Yes, it was September because it's the same date as 2024. So it would have been September 18th, 2007 is when they started cutting rates. So right when they started cutting rates, the 10 years trading around 4.5. And then you fast forward to the end of the rate cutting cycle right around here, and you got the 10-year treasury trading at 3.8, 3.9. So it did come down, but not a lot. And the Fed took rates from 5.25% down to 0. And then once again, during this rate cutting cycle, you had times when, I know this from memory, that the 10-year treasury from March up to May, June or so went up by 100 basis points, while the Fed was dropping by 100 basis points. So, just taking it, just trying to stretch the absurdity as far as you possibly can, just to play devil's advocate, you could say, well, interest rates are lower at the end of the cycle. But what that would completely ignore is this thing called the GFC. Like somehow the world coming to an end didn't impact the interest rates. It was just the Fed, right? So no one would argue that. No one in their right mind would argue that. So you have to say, okay, well, how much of this, even trying to give that argument the benefit of the doubt, that the Fed really impacts rates, in trying to give that the benefit of the doubt, how much of this was the Fed cutting by 5%, 500 basis points, and how much of it was just, and I don't know, did I say the 10-year earlier? I was just looking at the 30-year, I'm sorry. But how much of this was just due to growth and inflation expectations plummeting because we had the GFC? And I think anyone that's just trying to be objective about this would say, well, most likely. I mean, that was most likely coming down to the GFC. And if you don't believe me, just look at this. Why is it that we had interest rates on the 30-year treasury and the 10-year treasury absolutely tank right here? Was that because the Fed dropped rates? No, that's because Lehman Brothers went bust. Growth and inflation expectations. So I think the main takeaway here, and let's go back to the 10-year. So see it bounce basically right back to where it was. The main takeaway is when you're trying to figure out interest rates, it's better to ignore the Fed. It's better to ignore debt, deficits, and it's best to just really focus on growth and inflation expectations. What is the expectations for nominal GDP? And that's going to give you a much better compass, so to speak, as to where interest rates are going. So if, as an example, you can look at the labor market and you can see, oh my gosh, we're getting a big deterioration there. And if it's your base case that we continue to see this deterioration, then you can say, okay, well, my base case is probably, if we fast forward, a year or so, interest rates will most likely be lower, regardless of what the Fed is doing, regardless. And if the Fed just stays put right here, let's say 3.5%, and you have or think about that one as a thought experiment. Let's assume for a moment that the Fed over the next year keeps rates, the front end, at 3.5%. And let's also assume we have continuing negative non-farm payrolls. And then we have a couple quarters of negative real GDP. But the Fed has the front end pegged at 3.5. Where do you think the 10-year treasury is going to be? I can tell you it's going to be lower. It's going to be a hell of a lot lower. Where's the 2-year going to be? Where's the 3-month going to be? Where's the 1-year going to be? Way, way lower. I would argue the 30-year might even be a lot lower than Fed funds. You're going to reinvert the curve. right? And so this just is another thought experiment. I mean, they're limitless. Another one of these thought experiments that show you that if you want to be certain, you want to be religious about this, if you want to be biased, because if you want to push a narrative because it just makes you feel better or it makes you sleep well at night, or being on team X or team Y makes you feel really good because you're part of a group, that's fine. That's totally cool. I get it. I get it. But I would highly advise against using those conclusions to set up your portfolio. Because when you're setting up your portfolio, this is not investing advice, but it seems prudent to me to be agnostic and to be as objective as possible. And the only way that you can be super objective is if you fact check CNBC, if you fact check George Gammon, fact check everybody, especially in terms of something that's so important, and that would be interest rates and what actually moves interest rates. So, and hopefully, just by going through these charts really quick, you see why I always say that interest rates don't control the economy. Interest rates don't control the economy. They are a reflection of what the expectations are for the economy. And if you need any proof, just go back and rewatch the last 15 minutes of this video, or just go ahead and pull up those charts yourself. It takes 10 seconds. They're right here. This is just a Fred chart that I made by editing right here. Super, super easy. And then just Fed funds. You guys can find that. So just do the quick, I mean, it takes a half hour. So just do it yourself. And if you want to fact check me, and then come to your own conclusions. But I think the conclusions that you will come to is that, wait a minute here, what interest rates are doing, you see, is they're just reflecting what the expectations are for the economy. They're not controlling it. They're not controlling it. It's like, this is a great example. This plummet in interest rates all the way down here, was that somehow boosting the economy? Was that somehow making the economy awesome? No, it was a reflection that the world was ending, or that was the expectation that the world could be coming to an end. And I'm just talking about a deflationary bust. Right? Now, there is an argument saying that, well, these interest rates being this low are making it better than it otherwise would be. Okay, I can say that's has some merit, but it doesn't mean that it's controlling. That those are two completely different arguments, right? And then you would still have to admit, even though you're saying, well, it's better than it otherwise would have been, you still have to admit that the movement in rates was not generated by the Fed. It was generated by the market expectations for the real economy. So I know there's a lot of these things that I say all the time on these videos, and you know, it seems like I'm just saying it on a whim. And a lot of times, and I see how people can make this mistake, that it seems like I'm saying this just because it's my opinion, and that it's not really researched, or it's just, it's my opinion. It's my opinion that debt and deficits don't matter. It's my opinion that the Fed doesn't matter. And that's very rarely true. It's usually because I've done about 3,000 YouTube videos on this stuff. And believe it or not, I've had to do some research, especially for those whiteboards. Those whiteboards are extremely difficult. And if you don't believe me, try one. Try to take something like quantitative easing or what drives interest rates and try to do a whiteboard on it for YouTube. See how you do. And what you'll find is that you've got to know the subject material extremely, extremely well in order to pull that off. And so anyway, but also too, it's not fair that I say these things just right off the top of my head, assuming that you guys are going to assume that I did the research when I should explain myself a little bit more. That's what I'm trying to say. If I say something like this over and over and over again, occasionally I should explain why I've come to those conclusions. And I think then it would, maybe it would give some people a little bit more, at the very least, it would give them more understanding as to why I've come to the conclusions that I have come to. And by the way, I am totally open to being wrong, totally open. Like if I saw evidence for that I have just missed of how the Fed actually does control interest rates, I'm open to that. I want to be open to that because I want to incorporate that analysis into my portfolio. Why? Because at the end of the day, I don't care about a religion. I don't care about being right or wrong. I care about making money. That's what I care about. Sounds crazy, right? So anything that I can include into my analysis that will give me an edge to make money in my portfolio, even if it means what I thought before was wrong, I'm all about it. I'm all about it. And I think that's maybe one thing that makes me a little bit different than some of the other talking heads out there. All right. Ooh, so we should have Jerome Powell. Mr. Powell, let's see. Okay. Are they going to have this? I can probably just go to YouTube. Let's do that. Oh, shoot. I'm going to have to. So let's go to YouTube here. And I'm going to have to switch up the screen share. Josh was just about ready to remind me, I'm sure.
I was just about ready.
All right. So let's switch that up. Go to YouTube. Share. Okay.
Tus dólares hasta 6% efectivo anual con Global 66. Descarga la app.
In September.
Josh, can you hear that?
In the labor market, although official employment
Yes, we
data
can.
and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market.
You know what's funny and kind of sad, Josh, is I see there's about 7,500 people watching this right now, and there's almost as many people watching my live stream as. Anyway, let's get back to it.
For September, the most recent release showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs.
Well, I don't want to cut him off too often, but why? Why would it go up to 4.5 and then come down after that? Like, just pulling that out of your rear end, I think.
In mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP.
Josh, remind me, when I start doing merch again, we have to have a t-shirt that says volatile food and energy prices. It's one of my pet peeves that they can't say, it's not possible for them to say food and energy prices without saying volatile first. It drives me crazy.
P for total PCE inflation is 2.9% this year and 2.4% next year. a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem.
We haven't even seen a one-time shift in the price level. I mean, a couple things here and there, but the tariffs have been eaten by the U.S. importers, or at least 90% of them. 10% maybe the consumer, but that's done. That's ancient history, my friend. It's time to move on. How long are we going to talk about this boogeyman of tariffs creating inflation? I mean, are we going to zoom out 10 years and the Fed is still going to be, oh, but wait, but we could see that tariff inflation from 2025. I mean, come on. At a certain point, you've got to just get over it and be like, okay, we're probably not going to see a big boost in prices and definitely not an acceleration to inflation due to tariffs. I mean, it's.
But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a 1/4 percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through.
And if you didn't watch the first or the last 20 minutes, go ahead and watch that and just see what 75 basis point cut during a rate cutting cycle actually did anything to support the labor market when you consider the most important interest rates are, let's just say, the 2-year out to maybe the 10-year in terms of the real economy. I mean, let's just really super quick here. If we go back to most recent, look at this. So they cut 75 basis points. Woohoo! Great. The long end of the curve is basically the exact same. I mean, how can you argue that that is supporting the labor market? I mean, it's insanity. It's just completely ignoring the facts and ignoring the data here. And then even if you want to look at the 2-year, you could say, well, that's down. Sure, it's down, but that doesn't necessarily mean it's down because of the Fed dropping rates. If it was, then why does the 2-year always precede the Fed funds rate? Oh, whoops. Wrong. Oh, shoot. You couldn't see that.
The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills,
What an idiot.
for the sole purpose of maintaining an ample supply of reserves over time.
What a freaking idiot. So why is he an idiot? Because if there is tightness in the short-term funding markets, it's because of risk. It's not because of lack of bank reserves. And if it is a function of risk, then what are you doing by buying T-bills? You're taking the one thing, the one source of collateral that the market needs if there's higher risk. And by the way, even if there's a lack of liquidity, how are the banks going to create that liquidity? They're going to be able to create more liquidity if there's more collateral. If you just take out the collateral and just give the bank reserves, that doesn't do anything. That's making it worse, not making it better. If you're worried about the short-term funding markets, this is completely backwards. It's and by the way, you would think he would know that, because remember when the repo crisis happened in September 2019, what did they do? They immediately started buying bills. Remember, because it's not QE because we're buying bills. Remember that? And then what did he do like 3 weeks later? It's like, oh, sorry, we're not going to buy bills anymore. We're going to buy the longer duration. We're going to buy longer maturity. Why is that? Because the market came to him and said, hey, idiot, you can't take away this collateral that we need to provide the liquidity for the repo market to begin with. Jeez.
Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves.
On.
As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions.
Josh, write this down. And for those of you watching right now, I'm going to go ahead and make a prediction. I predict that within 3 months, they're not going to be buying bills anymore. They won't. I doubt they'll even do a press release. But if you go look at the data, if they're still buying and still, because the market needs Fed liabilities. Oh, we got to give them more liabilities, which are bank reserves. If they're still doing that, it ain't going to be by buying T-bills. It's going to be buying further out the curve. That would be my prediction. You heard it right here first. We'll have to see what happens over the next 3 months.
In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning, and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Yeah, actually, sorry, Jerome, your actions really don't impact businesses and people around the world. Sorry to break it to you, buddy. And by the way, if you're questioning my take, there's another one of these things that I probably haven't explained well enough on risk versus just amount of reserves in terms of, let's just say, liquidity in short-term funding markets. Just ask yourself a simple question. Based on the SOFR rate, which is what Powell is referring to here, in let's just say repo. Okay. So if you look at the repo market, if you look at the interest rate for the day in repo, let's say, so this would be SOFR would be a proxy for that. So let's say the SOFR rate is 4.1%. What you need to understand is that the repo or the SOFR, the rate that every single entity got was not 4.1%. No, it was, that's the average. So you could have, let's say, 1,000 financial entities that accessed the repo market and borrowed in repo short-term funding that day, and each one of them got a different interest rate by the was given a different interest rate by the counterparty. Why? A, different risk. B, different collateral, which effectively is different risk. So if risk doesn't matter, then why do we have 1,000 different repo rates for each individual transaction in the repo market every single day? Why? It's obvious. The answer is yes. The collateral matters, and yes, the risk matters. And it's just, it really, as you can see, gets under my skin that was just brushed aside, that little footnote. And we're just supposed to assume that the only reason why you have tightness in these funding markets is just because there's not enough bank reserves. Again, it's like a psyop. It's like a psyop that they have to come out and say these things to make them seem important, to incentivize or to manipulate markets into doing what they want markets to do, or market participants, because they know that mechanically what they're doing isn't doing anything, if anything, counterproductive. But they have to make it seem like they're doing something, or else the ruse is up. It's like the Wizard of Oz, right? They want to make sure that that door to the closet isn't opening up, because if it did, everyone would be like, well, wait a minute, you're nothing. You don't have any power. And then that's the whole central planning thing, right? Then you can't centrally plan, is my point.
At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data.
Oh, that just made interest rates go up, I bet. I bet that just made the 2-year go up. So we're delayed here because I've been stopping it. But I'm just really curious. Let's go to the 2-year. I'll bet that one statement made it spike. Yeah. My guess is Powell said that right here. And then it spiked. And the reason it spiked is because that was a hawkish statement. But let's go back here.
And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and it to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
And notice it's all, he's cherry picking there, because he's sitting there talking about how the shutdown, this is just like pent up demand. But yet what he doesn't say is all the demand that was pulled forward by front running tariffs. So I don't know, Jerome. And then what he's doing there is, and I'll give him credit, it is true that you've had a significant impact on GDP due to this AI spending and CapEx. That's for sure. But I think what you would have to ask is say, okay, well, if we're at, I don't know what nominal growth is right now, especially when you look at the labor market, like, look, we've had a massive deterioration in the labor market. He admits that. And we've had that with all the AI CapEx. So are we to assume that the AI CapEx will be more next year? Probably not. It'll probably be less. Now, will that still impact GDP? Absolutely it will. Absolutely it will. But my point is, if you have negative non-farm payrolls, if you have negative ADP, that's fewer jobs. I don't care how many illegals went home. It's still, the bottom line is fewer jobs and less aggregate demand. And so if you have fewer jobs, less aggregate demand, even with AI CapEx, I don't know that we can safely assume that just because we have AI CapEx next year, that we're going to expect a booming economy and going back to extremely high levels of growth. I mean, that's completely inconsistent with history. Just go back and look at history when we have negative ADP numbers and we have negative non-farm payrolls. What you're going to find is you're not going to find economic growth right there. You're going to usually find economic contractions. And by the way, if we were going to get economic growth, do you think the 10-year Treasury would be trading just barely above, well, I guess it's not barely above Fed funds now, but do you think the 10-year Treasury would be trading below nominal GDP? Like the 10-year Treasury right now is trading at 4.17. Okay. Do you think that the 10-year Treasury yield, do you think we would have a yield curve that looks like this? If the market was expecting really great growth, where you can go 3, 4, let's see, let's call it 3-4 years out the curve and we're still inverted, that is not the market predicting growth. That is the opposite of that. You say, George, the curve is steepening out. What about the 30-year? Yeah, let's go back to this and notice what happens every single time in one of these. That's the 30-year rarely plays ball. Not every single time. Let's go back to the GFC as an example, because that's really kind of blatantly obvious. And then, so during the GFC here, we see that the 30-year Treasury right here, it's not even doing close, like we said, to what Fed funds is doing. And it's actually steepening out. Right here, with these two together, that means the curve between the 10s and the 30s is pretty flat. But then right here, this big delta, or increasing delta, that's going to be a steepener. And that's going to be what we call a bull steepener, right? So you get a bull steepener here, and where basically the 30-year is flat, but the 10-year is going down at a faster rate. And that's exactly what we have seen here in 2025. if we've seen the exact same bull steepener where the 30-year is basically flat and the 10-year has gone down quite substantially, then of course the 2-year has gone down even more than that. You get a bull steepener, that is not the market saying that it expects high levels of growth next year. That is the complete opposite. Now, could the market be wrong? Sure, absolutely. But if I'm going to bet one way or the other, again, being completely agnostic, I'm going with the market. I'm not going with the Fed.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now.
You see, I got to stop pausing this thing, but it just drives me crazy. That sounds like Steve Leisman. You see what he's doing? He's playing the kabuki theater. He's claiming that the emperor is wearing brand new clothes. He's playing into the delusional fantasy that you've done these preemptive cuts. So you've done enough, right? You've done enough of these preemptive cuts to where now the labor market is really going to start to boom. When, again, you guys saw what I just did. We just went back to the interest rates and saw that, like, the 10-year, it's come down. It's probably at the same levels when they started cutting rates back in 2024. So how can you sit there and say, based on what you see, that, you know, the rates are all over the place, regardless of what the Fed's doing, even a rate cutting cycle, that somehow just by coming down to where the rates already were, where they were pricing in at the front end of the curve, that's somehow going to support the labor market? See, he's assuming that this is true, just playing into the delusional fantasy.
In the January meeting, and I'm sure we'll talk more about that. And that will, the data that we get are going to factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them. And
okay, I got to call excuse me if there's kids watching, but I got to call bullshit again. I can't take it. I can't take it. I can't take it. So see what he's implying there? Again, the Fed is all powerful. That when we raised interest rates, well, then we started to see inflation come down. Okay, let's go ahead and do a fact check on that one, or at least what he's implying here. So we can go ahead and look at Fed funds. I've got that right here. They started, let's see, they started raising rates in 2022, right? April 2022. And inflation was, inflation peaked out. We know inflation peaked out about August of 2022. So inflation, when they're raising rates, is still going up, right? Still going up. And then when they get here, let's say July of 2022, and when they start pausing, then what was happening to CPI? It was still coming down. So they're just basically, you see what's happening. Now, what they would probably argue, I guess, is that the interest rate policies have like a lag or something where, yes, the CPI was going up while the Fed was cutting rates, but that's just because the CPI didn't know how tough we were going to be. And all of a sudden, once we got up to think about that. Once you got up to 2.3%, the CPI was 9.1. 9.1. And you think that by taking the front end of the curve from 0 to 2.5%, that's what brought down interest rates? or that's what brought down the CPI. And by the way, even if that is what brought down the CPI, if an increase of 2%, let's say, had that much of an impact to bring the CPI down, then why on earth haven't you been able to bring the CPI down even further by increasing rates another 2.5%? See, it's just whatever is happening, it's the difference between causation and correlation. And what happens is when there's these correlations, even though that it really doesn't match up, they just assume that everything that happens is a result of the central planning. It's just, well, we raised rates, and even though the time frame really doesn't match up, and if you really think about it, it doesn't make a lot of sense. But just because they happened in a reasonable amount of time, then it must be because of what we did.
Case inflation to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, you know, we feel like where we're positioned now we're well positioned to wait.
And along the same lines, they've cut 175 basis points. And what's happened to the unemployment rate? It's gone up. It's gone up. So, I mean, I could just, it's just, you just think about this that much, and you see that this is all just bullshit kabuki theater. It's just a psyop. That's all it is.
See how the economy evolves from here.
If I could just follow up on the SCP, you have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So it is, the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing, but that's certainly the implication.
How's that? Yeah, that doesn't make sense, because I get it, what he's saying with higher productivity, but if you have higher productivity as a result of AI, that's going to be a massive decrease to aggregate demand, because that's fewer jobs. So that's, I'm not going to harp on that too much, because, you know, asking the Fed about AI, I mean, come on, that is, they don't even understand what's in their wheelhouse or within their wheelhouse, let alone something that's completely outside of their wheelhouse. I would not expect the Fed to have a really good prediction on AI or what that's going to do to the economy.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you ultimately where do you think the bigger risk is? And you know, it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do,
No,
this is what
not.
you see. And I think
It's just not. It is so not. Again, I got to call him out. I'm sorry for I don't want to pause it this much. I apologize, guys, but I can't take it. I can't take it. If he says something that's just complete BS, I've got to call him out on it. So, like, let's go back to this. and we'll go back to the GFC, which is, remember this right here? Remember this huge increase in interest rates? Why did that happen? That happened, and this is during 2008, by the way. This is the beginning of 2008. It was happening because the CPI was ripping higher. I mean, ripping higher. Not like the CPI now, where it goes from 2.4 up to 3. I'm talking about the CPI in Q4 of 2007 being right around 3.5%. And by the summer, call it June, July of 2008, it was at 5.6. 5.6. You imagine that would be like the CPI going from what was it? 2.5 roughly. That would be like it going up to 4.5 or 5%, not 3%, where we are right now. So this happened during the GFC. Okay, at the beginning of the GFC, before the stuff really, really hit the fan. But as you can see, it was within the time frame that the NBER called a recession. Now, what was happening to the labor market during this time? The labor market was tanking. I'm talking about every single month almost. When you look at revisions, we had negative non-farm payrolls. I mean, the labor market was in just dire straits. I mean, it was completely collapsing during this time frame, when the inflation rate was going up. So to sit here and say that this is unprecedented or this is somehow unique, no, it's not. We see this in almost every single cycle, where you get these waves where it's like, oh my gosh, the Fed's cutting too much, inflation, 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 while we see the deterioration in the labor market. We saw it in the .com. You guys, if you're just new to the video, go back 20 or 30 minutes, and I went through every single one of these cycles, and you go back to the .com, same thing. We had time frames in there where the long end goes up by 75, 100 basis points. Why? Because everyone was worried about inflation, while the labor market was deteriorating. So this is nothing new. We see this literally at every single cycle. And I'm just a schmuck on YouTube. If I know that, then how does the Fed chair not know that? The answer is he does. And this is just a total psyop. And that's why one of the main reasons I get frustrated about this. Let's go back.
It's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple of times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know.
Again, but by cutting the overnight rate for interbank lending by 75 basis points, you actually want to look me in the eye and argue with a straight face that that's going to have a massive impact on the economy, but it's just going to lag 6 months. Come on. Who are we trying to kid?
Quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted. And that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down? Or should we think of policy risks as genuinely two-sided from here?
What an idiot. What an idiot. More frustration. Why? Let's go back and look at the, first of all, I guess we could look at the unemployment rate. Look what the unemployment rate was doing during this time. It's just flat. It's just not doing anything. I mean, it's right here. I mean, the unemployment rate's still going down. Nick, did you see anything like this, my friend? Did you see anything like that, Nick? No, you didn't. Why? Because this was not an economic contraction or any risk of an economic contraction. And Greenspan just wanted to cut rates, right? You can't sit there and we have a deteriorating labor market. Even your hero, Jerome Powell, admits that. We did not have a massively deteriorating labor market back then. That's number one. Number two, and this is a real biggie. We should get to this by the end. In fact, I want to go over this very, very quickly just so I don't forget. And this is the delta between the 2-year Treasury and the Fed funds rate. So 2-year Treasury is the blue line and Fed funds is the green line. Now, I want you to notice what happens in every single one of these cycles. Every single one. When you get to the end of the cycle, guess which is lower, the Fed funds rate or the 2-year Treasury? That would be the Fed funds rate because the curve naturally steepens out, right? So where are we now? The Fed funds rate is between 3.5 and 3.75. So just call it 3.6, okay? And we've got the 2-year Treasury right now at 3.55. It's still under. It's tanking, by the way. It's still under Fed funds. So what is this telling you? This is telling you that most likely, again, no certainty is only probability, but most likely the path of the Fed funds rate is down. It's not up, Tim. I mean, can you see, again, the issue here with Tim, just to give him the benefit of the doubt, is you're completely excluding everything else except just the Fed funds rate and the Fed policy decision. I mean, let's go to the 2s and 10s. Hopefully I've got that up. I do. Okay, so now let's look here at 1995. Do you see an inversion anywhere here, Tim? Do you see it? You don't. Why? Because it didn't happen. It didn't happen. So you had no inversion of the curve. You had the labor market that was fine. And by the way, you know, there's an argument, I might have popped up a bit, but the labor market was not showing the deterioration, just using the unemployment rate as a proxy. But if you go back there, I can almost guarantee you, I don't have the data in front of me, but we did not have massive amounts of negative non-farm payroll prints or negative ADP prints. Maybe you had a couple due to weather or something like that, but nothing to the degree to which we have had, nor have we had this. Look at this massive inversion of the curve, which in and of itself tells you, why do you have an inversion of the curve? Because the financial institutions see a lot of risk, and they'd rather take that balance sheet capacity and allocate it to the safest, most liquid asset, which is treasuries. So you have a bid for treasuries while the Fed is increasing rates because they're behind the curve, no pun intended. And you get an inversion. That's why we have an inversion to begin with. No inversion back here, Nick. No inversion, my friend. If you think the Fed is the next Fed move is going to be increasing interest rates, again, maybe they will. There are no certainties. All I would say is the probability of that is incredibly, incredibly low. Maybe it's different this time. Always a possibility.
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, you know, a data set of 2, now 3 is not a big data set, but you are right about those 2 3-cut times in the 90s.
If I could follow up, the
2
unemployment rate has
3-cut
been-
times. What? Okay. Oh, he's talking about right here. He's talking about right here. Ah, okay. I thought it was just 1. So let's go to that. Maybe I'm wrong. Now, I would say that if you've got, 4 out of 5 times, if it plays out like this, probability is still on your side. But let's see. Maybe the curve was inverted here. Maybe we had the unemployment rate spike. So that would be, what is that, 98 to 99? Let's check that out. Yeah. You had teeny weeny inversion. Just slightly. Okay, so I'll give him that. I'll give Nick that. But let's see the unemployment rate. Oh, where was the unemployment rate here? It's just other stuff. Shoot, where was the I had that up. Oh, there it is. Yeah. So again, apples to oranges. Excuse me. You don't have it here. You have the labor market just going, or the unemployment rate. Excuse me. During that time, going straight down. You got it going straight down, and maybe you could argue a little blip here from 4.3 to 4.5. You've got a slight inversion. And you could argue that that inversion was just part of the larger inversion.
Are you trying to show a different screen right now?
Yeah, shoot, I forgot. I'm showing all these different screens. That sucks. Sorry, guys. I was just showing like 5 different screens. And I've been doing it the whole time, forgetting that we're stuck on this stupid screen. But you'll just have to look it up. You'll have to. Gee, that's the benefit here of doing a live stream, right? With no edits, is I totally forgot. So if you go to I'm not going to go back there. Well, let me do that. We got a lot of people. I've got about 10,000 people watching. So let me just take a quick second just so I can get everyone up to speed. And then we'll go back to Powell. Okay, so now we've got that. Josh, do you see the unemployment rate? Where was it?
Once you clear up the 1,000 tabs, I'm sure we will.
There it is. You see it?
Got it.
Okay, cool. Sorry about that, guys, and thank you, Josh, for reminding me. But what we're looking at is right here. So in the first rate cut that Timros was talking about was right here where the unemployment rate went. Okay, what did it do? It went up from 5.4 to 5.6 or so. All right. And then there was no inversion of the curve, at least 2s and 10s. And then we get to 98, which is the second one he's talking about. And we had a slight inversion of the curve, but nothing in the labor market. Nothing in the labor market. No massive deterioration. So to sit there and those are the two big components. So without that, to compare this to what we're seeing today is just, it's disingenuous, or it's intellectually, I don't want to say dishonest. It's just, it's not intellectually thorough. That's a much better way to say it. Okay. Now let's go back and switch up the screen share.
Very gradually for the better part of 2 years. And indeed, the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see.
How? Just, okay, Josh, we've got 10,000 people basically on the live chat. For those, let me just talk to the 10,000 people that are on here right now. I'm sure a lot of you are small business owners, or maybe mid-sized business owners, or maybe even large business owners. I'm sure a lot of you are entrepreneurs. How many of you have gone out and hired a bunch of people over the last 3 months just because Jerome Powell dropped the Fed funds rate by 75 basis points? Go ahead and tell me in the chat right now. I'll wait. For those of you who are entrepreneurs, just say yes or no as to whether or not you've hired a bunch of people due to the fact that the Fed just cut by 75 basis points. In fact, I'll take it one step further. Tell me, for those of you who are entrepreneurs, if you have ever in your life hired people just because Jerome Powell was cutting interest rates.
I'm actually just waiting for QE, and then I'm hitting the go button.
There you go. Then it's pedal to the metal. Of course not. This is nonsense. So then the only argument could be that somehow by lowering the overnight rate that banks charge each other is somehow going to just massively boost aggregate demand. And you're going to see that at your local, the dry cleaner that you own. And you're going to be like, holy cow, I got to go hire some more people. Whoa, I've never seen demand like this. Boy, I sure hope the Fed keeps cutting. I mean, you see, when you hear it over and over and over again, it's kind of believable. But when you actually think it through in terms of the real economy, you're like, wait a minute, this is ridiculous. This is completely ridiculous. That's why I get so frustrated. All right, let's go back to it. Have I got the right screen shared now, Josh?
If you're trying to play Jerome Powell, yes.
Okay.
Any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation. And as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would point to a couple of things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000. So that would be negative 20,000.
Whoa, 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 whoa. Whoa. Did you hear that, guys? I was not expecting that. That is a bombshell. That is a bombshell. We have averaged, he's talking about non-farm payrolls, I believe here. He said we've averaged, 40,000 over the last, I forgot what he just said, 6 months or so. But he said he thinks they are overstating it by 60,000 a month, which makes sense when you look at all the revisions. But that would bring the non-farm payrolls for the last 6 months down to an average of negative, or however many months he said, down to an average of negative 20,000. Now, I would challenge, I do it now, but I got to switch up the stupid screen share again. Now, I would challenge you guys, and you can use AI for this. Go back and try to look at the last 50 years and look at when we have had negative non-farm payrolls, and look at when we have had like 6 months in a row of non-farm payrolls, and try to find and see if there's a correlation with recessions, and try to find a 6-month period where we have substantial negative non-farm payrolls when we're not in an economic contraction. And the point there is it's going to be tough to find. It's going to be very, very, very tough to find. So that in and of itself, and then you say, well, George, what if it's the 1970s, right? And I've pulled up this chart. Well, dang it. It's a stupid screen share again. I've pulled up a chart. You guys have seen it. Even in the 1970s, when you had a slowdown in the labor market, the unemployment rate spike, you had the deterioration, negative non-farm payrolls, et cetera. You had disinflation. You did not have a reacceleration of inflation. Now, you saw prices going up, but they were disinflating. They are going up at a much slower pace, right? So my point there is, if you're trying to weigh the balances here of probabilities as to should we be more concerned with the labor market or more concerned about inflation, dude, if you've got negative 20,000 jobs per month on non-farm payrolls and you look at history, trust me, you should be way more concerned about the labor market than you should be about inflation
per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower. And I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods. And that goods inflation is entirely in sectors where there are tariffs. So that does build on the story. And so far, it's only a story that that the goods inflation, which is really the source of the excess at this point, that almost more than half the source of the excess inflation is goods, is tariffs.
How do you, okay, I'm going to give him this. I'm going to give him this because it is true that tariffs have slightly increased prices, but that is by no means to say that we should assume that it's not just a one-time price adjustment, right? And oh, by the way, again, we go back to the majority of the tariffs are being paid by the U.S. importers. That's without question. And you can tell that by the import price data. And then next, I would say, I don't know that the large portion of the CPI is due to just these goods that are impacted by tariffs, but more so housing data. It's more so your stupid lag in housing that doesn't pick up the real-time data of what's happening with prices or what's happening in rents. And if you actually had real-time data there, or if you strip out housing, then you're going to be you're definitely going to be well, not definitely, I shouldn't say that because I haven't done the research, but my guess would be, and I'm going to say this with quite a bit of confidence, that you would be sub 2% if you stripped out housing.
And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today.
How do you have a hot economy when you have negative 20,000 non-farm payrolls a month? How can you be worried about a hot economy? And if you're not worried about a hot economy, why the hell would you be worried about an acceleration, not just a price adjustment, but an acceleration due to tariffs? Even if those importers tried to pass on 100% of the cost of the tariff, guess what the consumer's going to do? They're going to puke it back up because they don't have the money, because they don't have a job. like great, increase your prices. Woohoo. What's that going to do? Nothing. And then what's going to happen is you're going to be like, whoa, pump the brake on the price increases. And you're going to drop the price back to where it was before and eat the margin, because if you don't, you're going to go out of business. This is the issue here with why you can't just look at the price of oil. This is one thing that people do all the time. As an example, they look at the price of oil and they just assume that if it goes up to 120 a barrel or whatever, that's going to lead to long-term inflation. No. In fact, a lot of times that's what leads to disinflation, because you have the oil prices go up, which is a tax on the consumer, but yet their wages don't go up at the same rate. So what happens to their purchasing power? It goes down. So you get a big spike in oil, and sometimes that does spike the CPI, but then it comes right back down because the people just don't have the purchasing power to pay the high prices. Aggregate demand goes down, and volume of goods and services sold goes down dramatically. That's exactly what we saw during the GFC. And there's no reason to think that even if you do have that one-time price adjustment, if you have a deteriorating labor market, that somehow that's going to equal over the long run prices increasing and going higher and higher and higher and higher and higher and higher. Where the hell's the purchasing power going to come from?
It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going.
Yeah, right, Jerome. It has nothing to do with risk at all. There's no way it can have anything to do with risk. It can only have to do with the amount of bank reserves. Come on. When remember that the repo rate is an average of about 1,000 different rates based on risk every single day with counterparties.
Going to come. when it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop.
A low level. Okay. So prior to 2008, we had about 40 billion of bank reserves. And I'd like to point out 30 billion of that was vault cash, meaning that's not being used for interbank settlement. So you had about 10 billion of reserves that was actually being used for interbank settlement. Now, I haven't looked at the chart lately, but I would assume, and I've probably got it up, well, I got to do the screen share, but we're probably around 3 trillion in bank reserves. 3 trillion from 10 billion. And you're telling me that that's not ample? Like, I get it. SLR, Basel. I get all the regulations. There is no way that just regulations alone would prompt you or would facilitate the need to go from 10 billion to 3 trillion. 3 trillion. Come on. And M2 money supply went up from 7.5 to, what was it, 22? Something like that. So you had a double, it's up by 200%. Yet the amount of, I don't even know what that is. I can't even calculate that percentage going from 10 billion to 3 trillion. And somehow you want to argue that we don't have ample reserves. I mean, you just, in order to believe this, you just have to completely ignore history. You just have to completely ignore the data.
Sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part that's going on. It's also happening in the context of a temporary.
So you have to increase it by 25 billion a month when M2 money supply, let's just say, is 22 trillion. I don't know what it is. Let's just say it's around that. When it was 7.5 trillion, the total amount of electronic reserves for interbank settlement was 10 billion. And somehow you have to increase it by 25 billion a month right now. God. Again, I'm at a loss of words. It's Will Ferrell. It's just we're living in crazy pill land.
Very few month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think.
Another thing that's weird too is all these guys asking questions. it's all 1990s, 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 1990s. Why doesn't anyone say, well, what about, do you think this is similar to 89? Do you think this is similar to 2000? Do you think this is similar to 2007, 2008? Do you think this is similar to 2019? Why is it that the only question they can ask, the outcome is that the economy doesn't go into recession? And they completely ignore the vast majority of times when it actually goes into recession. It's a bit of a head scratcher, isn't it?
I think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's,
if you're new to the stream here, this is not a unique situation. That what he's talking about is the spread or the delta or whatever, the convergence of the labor market and inflation. It happens every single time. It happens every single time in these cycles. You get a 6-month period or whatever it is when growth and inflation expectations accelerate. Sometimes it's due to the CPI flat out going up, like we saw in 2008. And while at the same time, the labor market is deteriorating. It literally happens every single time. And yet no one fact checks him on it. Like, how is this? Like, I almost flunked out of high school. I'm just some idiot on YouTube. How is it that the people that are right there in the room with him aren't saying, well, whoa, you say this is unprecedented, but the exact same thing happened in 2008. How do you explain that? This is just, these questions are all just fluff. They're just nonsensical fluff and drivel.
That's just unique in my time at the Fed. And I think going back a long ways, we haven't had that in our framework.
And by the way, if he truly believes that, we got problems. Like if he truly believes that, that means that he hasn't even done enough research to know that this is not true. That in and of itself is frightening.
As you know, says that when that's the case, that we try to, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happens.
Basically, what he's saying right here is he's saying we're worried about getting kicked in the nuts. Let me just put it down to brass tacks here in a way that everyone can easily understand. He's saying we're really worried about, we're kind of sitting like this, like that meme where the karate guy's kicking the dude in the nuts over and over and over again. We're sitting in that position where we're primed. We're in, we're getting ready. That dude's coming over and he's going to be kicking us in the nuts. But it's one of 2 dudes. You don't know whether it's the inflation dude that's going to kick you in the nuts or if it's going to be the labor market that's going to kick you in the nuts. But what you do have is 50 years, not that much, but you've got going all the way back to the 1980s, where every single time you got 2 guys walking up to you to kick you in the nuts, the labor market dude is the guy that gets you every single time. But yet somehow this time you've got the 2 guys walking up to you that are getting just primed. They're getting warmed up. They're doing like squats, getting ready to kick you in the nuts as hard as they can. And you're like, I don't know who it's going to be. I don't know. This is unprecedented. I don't know who it's going to be. Is it going to be the labor market or is it going to be the inflation rate? When it's always the labor market guy kicking you in the nuts. Geez.
And that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, it takes, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase?
What good? Look, we got the tariff retardation day. We got that in April. So we got April, May, June, July, August, September, October, November. We have 9 months. Jerome, tell me the good that takes 9 months to get here. Just what good is it? Maybe there's some, but just using good old-fashioned common sense, I don't think there are a lot of goods in the basket that take over 9 months to get to the United States.
So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is, but call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really.
It's not that you haven't predicted this with any type of precision. You actually have. It's just the outcome has been the inverse of your prediction. So you've actually done a very, very good job of predicting it. You just predicted the opposite of what really happened. So if that was the case, if you had 1,000 batting average for being wrong, why would you expect that you're going to be right moving forward? Wouldn't you expect that you're just going to be wrong? I mean, I don't know.
Have precision on this, and after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got it when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break evens. And, they're at very comfortable levels. They're at levels consistent once you get out past the very short term now, break evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that.
So let me translate. The guy getting ready to the one of two guys that's walking at you, it's the labor market getting ready to kick you in the nuts. What's happening is the inflation guy is turning around and walking in the other direction. That's what he's saying.
I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on.
Here, I agree with him here. Obviously I'll say when I disagree, but here I agree.
And so the best thing we can do is restore inflation to its 2% goal. And our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money. And we're going to need to have some years where real compensation is higher, it's positive, significantly positive. So nominal wages are higher than inflation for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do.
Okay, Josh, I can't take any more of this. The questions are so stupid. I mean, these people, I don't what are the qualifications to get a badge or a pass to get in there and ask him a question? Like, I can't take that. It's one thing to be able to just handle the stupidity of Jerome Powell, and I'll give him credit. Maybe he's not. Maybe he's just. I mean, look, I'll cut him some slack here. He's got to put on the show. He's got to put on the show, right? So when I say that he's stupid, I'm not literally saying that he's unintelligent. I'm saying that what he is saying is stupid, and it's probably because he's got to put on the show because he realizes this is all just a psyop. And that's his only game. That is his only tool, is psychological manipulation. So don't get me wrong there but the people asking him questions are on the brink of retardation. And they're a combination of retarded and just ass kissers. So I can only handle Jerome Powell so much. I can't handle the retard ass kissers. So on that bombshell, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism, and we'll see you in the next video.